Have you ever poured everything you have into a project? You nail the deadline, you come in under budget, only to have your boss look at you and ask, "So what?" Yeah, it's a frustrating moment and it happens all the time. But here's the thing, the problem isn't your work, it's the language. We get caught up talking about tasks and bugs, while our leaders, they're focused on profit and ROI. So today, we're going to bridge that gap. We're going to hand you the financial toolkit you need to prove your impact and start making even smarter decisions. I mean, really, picture this for a second. You and your team, you've just pulled off a miracle. You fixed 1,000 nasty defects. You completed every single task. You shipped a huge project. You're feeling like you're on top of the world. And then you present your success to leadership, and you get a polite nod and that one single, soul-crushing question. So what? It's not because they don't care about your hard work. It's because you're not speaking their language. You see, it really just comes down to a language barrier. We're on the front lines, so we speak in operational metrics, tasks completed, sprints, defects fixed. But our leaders, they speak the language of the bottom line, dollars and cents. So to get the recognition and, frankly, the resources our work deserves, we have to become fluent in their language. We've got to learn the language of value. And this slide, wow, it just lays it all out, right? You've got two different worlds here. On the left, that's the world of execution. That's where we live and breathe, just getting things done. On the right, that's the world of strategy, where leaders are making the big decisions that shape the future of the whole company. Our goal today is to build a rock-solid bridge between these two worlds so you can show exactly how your hard work on the left is driving real success on the right. Okay, so to make sense of all these financial terms, we're going to use a really simple but powerful framework that honestly top consultants use all the time. We're going to split every single metric into two clean categories, backward-looking and forward-looking. Backward-looking measures tell us what we've already done, and forward-looking measures, well, they help us decide what we're going to do next. This simple split is going to give us so much clarity. Let's think of it this way. Backward-looking measures are basically your report card. They tell you exactly how you did, they grade your performance on that last project. Forward-looking measures, on the other hand, are like a map. They help you chart the best course for the journey that's ahead of you. And here's the key. You absolutely need both to be successful. You have to know where you've been to have any clue where you're going. All right, let's do it. Let's open up that report card and see how we did. We're going to dive right into the backward-looking toolkit. This is how we turn those operational wins into a compelling story of financial success that absolutely everyone in the C-suite is going to understand and appreciate. So let's start with the king of all financial metrics, return on investment, or ROI. This is the one number that, at a single glance, tells everybody if your project was a financial success or a flop. It's not just about how much money you made, it's about how much money you made for every single dollar you spent. It is the ultimate measure of efficiency. And the best part is, the formula is super, super simple. You just take your profit, or your gain, you divide it by your total cost, and that's it. That number is your ROI. It's the percentage of your original investment that you earned back as pure profit. It's clean, it's simple, and it is incredibly powerful. Okay, let's see ROI in action, because this is where it gets fun. In our example, a software company spent $300,000 to build and market a new product. In the first year, just the first year, they brought in $720,000 in revenue. That's a profit of $420,000. You do the math, and what do you get? A staggering 140% ROI. That's the kind of number that makes executives sit up, pay attention, and ask, okay, what do you need for your next project? Now, ROI is fantastic for a single project, but what if you want to measure the efficiency of the whole company? Well, that's where return on assets, or ROA, comes in. ROA tells you how good a company is at using everything it owns, its assets, like servers, factories, cash, to make money. It's really a measure of overall operational excellence. And just like ROI, the formula for ROA is beautifully simple. You just divide the company's net income by its total assets. A higher ROA means the company is more efficient. It's squeezing more profit out of every single dollar it has invested in its infrastructure. So let's check back in with our software company. Their net income from that project was $420,000. Let's say the assets they used, like their servers and computers, were worth about $200,000. That gives them an ROA of 210%. That is an incredible number, and it tells a story that goes beyond just one project. It shows they're not just profitable, they are incredibly efficient at using what they've got. Okay, so we know how to grade our report card. We know how to measure past success. But how do we make sure our future projects are just as successful or maybe even more so? Well, that's where our forward-looking toolkit comes in. These are the tools we're going to use to make smart, data-driven decisions about which projects to chase and, just as important, which ones to walk away from. So before you kick off any new project, you absolutely need to do a cost-benefit analysis, a CBA. It is the simplest and most effective way to figure out if a project is even worth doing. You just rigorously list all the projected costs on one side and all the expected benefits on the other. If the benefits clearly, obviously outweigh the costs, then you've got a solid business case. It's really just 3 simple steps to a powerful CBA. 1. Calculate the costs, and I mean all of them. Think beyond just the price tag to things like training, maintenance, and support. 2. Calculate the benefits. Will you increase revenue, save costs, improve efficiency? Put a number on it. 3. Compare the two. It's that easy, but it's also so powerful. A good CBA is the best weapon you have to convince your boss to say yes to your next big idea. You've probably heard the saying, a bird in the hand is worth 2 in the bush, right? Well, it's the exact same idea with money. $1 today is worth more than $1 tomorrow. Why? Because of things like inflation and opportunity cost. You know, the interest you could be earning on that dollar right now. This whole concept is called the time value of money, and it's absolutely critical for evaluating any project that's going to last more than a year. So how do we actually account for the time value of money? We use a tool called net present value, or NPV. Now, I know it sounds complex, but the idea behind it is really simple. NPV takes all the future cash your project is going to generate, and it tells you what all that money is worth in today's dollars. It lets you compare apples to apples so you can see the true present-day value of a long-term investment. Another really powerful tool is the internal rate of return, or IRR. Now, don't worry about that textbook definition on the screen. Here's a simpler way to think about it. IRR is like the effective interest rate your project is paying you. It tells you the annual percentage return you can expect from your investment. And if that interest rate, the IRR, is higher than what you could earn somewhere else, it's probably a good investment. Now, I know what you're probably thinking. Whoa, the math for this must be a nightmare. And you know what? You're right. It can be. But the good news is, you don't have to be a math whiz to use IRR. A simple function in Excel or Google Sheets does all the heavy lifting for you. Your job isn't to be the calculator. Your job is to be the strategist who knows when to ask the right question in the first place. Let's look at a quick example. Say a company is thinking about moving its servers to the cloud. It's going to cost them $50,000 upfront. That's the negative cash flow you see in year 0. But by doing this, they'll save $15,000 a year for the next 5 years. So the big question is it a good investment? Well, we plug those numbers into a spreadsheet, run the IRR function, and bam, it tells us the IRR is 15%. That is a great return. Let's say the company's minimum target for a project like this, they call it a hurdle rate, is 10%. Well, since 15% easily clears that hurdle, this project is a total no-brainer. It's a clear winner that's going to create a ton of value for the business. Have you ever loaned money to a friend and the first thought that pops into your head is, when am I going to get this back? That's the basic idea behind the payback period. It's a beautifully simple metric that answers one critical question. How long is it going to take to earn back our initial investment? The shorter the payback period, the less risky the investment feels. For example, let's say a company spends $115 million on a new factory. That factory is expected to bring in $20 million in cash each year. To find the payback period, you just divide 115 by 20, and that gives you 5.75 years. So in less than 6 years, the company will have made its entire investment back. Now, it's up to management to decide if that timeline and risk profile fit their overall strategy. Sometimes a game-changing project is worth a longer wait. Okay, we've learned some fantastic tools for measuring our individual projects, but how do we connect those project-level results to the bigger picture? How do we show that our work is actually helping the entire company hit its strategic goals? Let's zoom out and find out. One of the best ways to show your impact is to talk about market share. That's just the slice of the total industry pie that your company controls. So if your new marketing campaign helps your yogurt company's sales grow, you can draw a direct line from your work to an increase in market share, and that's a powerful story. It shows you're not just completing tasks, you're actively winning against the competition. Another great one is revenue growth.
It sounds fancy, but it's just a way of saying how much more money the company is making this year compared to last year. If your project improved a product that led to a 33% jump in sales, you can take direct credit for fueling that growth. And trust me, in business, growth is a very, very big deal. Now, when you're talking about savings, it is critical to know the difference between hard savings and soft savings. Hard savings are the real deal. That's cash you can actually see in the bank. For example, if you renegotiate a software contract and you pay $10,000 less this year. Soft savings, or what's called cost avoidance, are a little bit trickier. They're about preventing a future cost, like implementing a security patch that prevents a data breach that could have cost millions. Both are valuable, for sure, but hard savings are always more impressive because they show up directly on this quarter's financial statements. Wow, we have covered a lot today. We've looked at the past and we've planned for the future. Now, let's pull it all together into a simple, powerful toolkit that you can start using tomorrow to speak the language of value. Here it is. This is your new financial toolkit. Use ROI to prove what you've accomplished. Use ROA to show how you've made the entire company more efficient. Use a CBA to get your next big project approved. Use IRR to prove it's a great investment compared to other options. And use the payback period to show that you're thoughtfully managing risk. With these 5 tools, you can have a confident, intelligent conversation about the financial impact of any project. So, what's your story going to be? The next time you have a big win, don't just talk about the what, talk about the why. Talk about the value. Talk about the bottom line impact. You now have the tools you need to tell a story that will get you the recognition and the resources you truly deserve. So go out there and tell it.